A very good morning, students. Our session of Financial Management 1. Now, as far as our previous session was concerned, the last session we have seen about the introduction of venture capital. Now, along with the venture capital institutions, we have seen the guidelines for venture capital. I hope that point is clear to each and every one. Now today we are going to start with the new topic, that is mutual funds. Yes, mutual fund is a fund of capital market. Suppose a person, or we can say that an investor, wishes to invest in capital market in the different securities of the different organizations and the different institutions. But as far as the capital market is concerned, that individual does not have knowledge how to invest, where to invest, and how much to invest. So he gets confused about the different securities offered by the capital market. He himself is not clear that how he is going to make a fruitful investment in the capital market, that is in a stock market. So in this situation, when an individual does not have the knowledge about the market, they are going to contact the mutual fund companies and they are going to have a discussion that I want to invest rupees 5 lakh in the capital market, but I am not aware about the trends in stock market and I am not able to analyze the market condition on the basis of economic changes and on the basis of security offered by the different organization. So at this time, mutual fund companies help them and they are going to share a mutual agreement in which an investor is going to invest money in mutual fund companies, in different types of mutual fund of that particular company. And now mutual fund companies are going to invest on the behalf of investor in the capital market in different securities. Suppose my investment is rupees 3 lakh with SBI mutual fund. So first and foremostly, I invest rupees 3 lakh in SBI mutual funds. Now, it is a duty of SBI, that is to make a division of my total investment amount, and that process is known as diversification. So when the diversification is there, the company is able to minimize overall risk and going to enhance the return in that. So now mutual fund company is going to make a part of my investment, that is of rupees 3 lakh rupees, and they are going to invest in different avenues of the capital market, like they are going to invest in shares, debentures, bonds are there, government securities are there, foreign exchange are there, MCX is there, then after any security in the commodity is there, whether in a gold, silver or so on. So now when the division of my investment is there, I am able to mitigate overall risk of that particular investment, and when the risk is minimized, the return will be maximized. So this is one of the best advantages of mutual fund companies, that in mutual fund we are able to diversify our portfolio. Now my investment in different stocks, in different bonds, that will be known as my portfolio. Or in another sense we can say that portfolio is a basket in which you are going to arrange your security as per your choice and as per your convenience. So in mutual fund there is a diversification of the portfolio, and when the diversification of the portfolio is there, the chances of risk will be minimum and the chances of return will be maximized. So again repeating myself, the combination of different securities that an individual are having with the mutual funds, that will be known as portfolio. So mutual funds are for those who do not want to take the maximum risk in the direct trading in capital market. So they are investing via intermediary, and when the intermediaries are there are chances that the risk perception will be minimized. So let's see about the introduction of mutual funds. Mutual fund is a company that pulls money from and invests money in security such as stocks, bonds and short-term debts. So in mutual fund investment, there are chances that we are going to have the combination of different securities. The combined holding of mutual fund are known as its portfolio. Investors buy shares in mutual funds. Each share represents an investor's part ownership in the fund, and income is generated. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instrument and other assets. Mutual funds are operated by professional money managers, and now these managers are going to analyze capital market in a proper manner so that the interest of the investor will be maximized. Who allocate the fund's asset and attempt to produce capital gain or income from the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objective stated in its prospectus. Each and every mutual fund companies have their own prospects. In that prospect, they are going to share the information or the policies or the combinations of different funds that they are having in their own company, and through this prospects or through these policies, they are going to attract their potential investors. Now first discuss advantages of mutual fund. The first advantage is advanced portfolio management. Yes. Through mutual fund, an investor is able to get the benefit of portfolio management, because it is really very difficult for a single person to manage his own portfolio, because when portfolio is there, a constant analysis is required from the part of an investor. But now this analysis is going to be done by a professional mutual fund companies. So investor gets the benefit of this advanced portfolio management. Then after, the next point is dividend reinvestment. Here, the policy of reinvestment is there in mutual funds only, where we are able to reinvest our income, that is in the form of dividend, again in a mutual fund company. So it is a kind of cumulative dividend, where dividend is going to reinvest each and every year, and at the end you are getting the profit on a cumulative basis. The third one is risk reduction. In mutual funds, the risk is totally reduced, because there is no single investment in a single security, but the whole investment is divided into small parts, and they are going to make an investment in different securities, which is suitable for the investor's perception. So through mutual fund, the risk is totally reduced. So safety, somehow the mutual fund schemes are safe rather to invest directly. Then after, convenience and fair pricing. Investment in mutual fund is really very convenient, because here portfolio manager is going to create portfolio on the basis of choice of investor. Here customized portfolio is prepared by the mutual fund manager, and through this customized mutual fund, they are able to provide a fair pricing on it. And when the prices are fair, then there is no chance of malfunctions or manipulations. Then after the next one is benefits of factoring. Yes, the service of factoring is provided by the mutual fund companies, in which they are going to hedge the whole risk which are there in the capital market with the uncertainty. So, investors get the benefit of factoring via mutual funds company. Then after, diversification of investment. This is one of the main advantages of mutual fund companies, that they are going to diversify the whole investment. We are going to continue with the same example. If I want to invest rupees 3 lakh in the capital market, then mutual fund companies are not going to invest my 3 lakh rupees directly in the shares of Reliance companies, but they are making the part of this 3 lakh rupees, like 3 parts of 1 lakh rupees and 6 parts of 50,000. And now they are going to invest on the basis of the part of main investment, and that will be known as diversification of portfolio or diversification of the main investment. Now let's have the discussion of types of mutual funds. The first one, that is open-ended scheme. When any organization is going to have their mutual funds, so that mutual fund must have normally 2 types through which an investor is going to make an investment. The first one is open-ended. Open-ended scheme, there is no time limit for the investment, plus the numbers of shares, it is not fixed. An investor can easily repurchase and resell the new securities through the scheme of open-ended. So, it is totally open. When the maturity period is not there in the mutual fund scheme, that is known as open-ended scheme. While the next one is close-ended scheme. As far as the close-ended schemes are concerned, it is totally different from open-ended. In close-ended, the time interval is fixed. The shares offered by mutual fund schemes is also fixed. Here, the repurchase or resale of the shares are not possible. In close-ended scheme, there is a maturity of the particular mutual fund scheme. Once the limit is over, once the time period is over, the management is not able to purchase or sell the securities of mutual fund. And third one, that is interval funds. Now, there are many intervals of the funds in which they are going to focus on the short-term funds and long-term funds. As per the investor's choice, they are going to select the time period of their investment. So it is totally predetermined at the time of investment in any mutual fund schemes. So that will be known as interval funds. That is the combination of close-ended scheme and open-ended scheme. So that's all about mutual funds. Now we are going to discuss the another point, that is factoring institutions. In factoring institutions, these institutions are going to manage the credit of the organization. Now let's discuss with a simple example. If there is a sales and that sale is in the nature of credit and the credit term is of 3 to 6 months. So now seller is not able to get his payment before 3 months. But if the immediate cash requirement is there in his own business, so at that time he going to face the problem of liquidity, because there is a sale of lakhs of rupees, but right now they do not have any cash on hand, and if any immediate expenditures are there, if any immediate investment options are there, so the seller is not able to grab that opportunity. So now in these crucial situations, the factoring institutions are going to purchase the book debt from the sellers and pay a total amount to the seller before the maturity. So before 3 to 6 months, if there is a financial requirement, so seller is going to sell his book debts to the institutions who are providing the services of factoring, and they gets the advance amount from these institutions before the maturity period. and they are going to provide, or they are going to give the book debts to the factoring institutions, and factoring institutions pay the amount with the little bit discount, because they provide money before the maturity period ends. So in a return, they are going to charge the discount from the sellers, and when the maturity period comes, at that time these factoring institutions are going to collect the debts from the purchaser, and they are going to enjoy the full amount of the debts. So these institutions are going to breach the short-term financial requirement of any institutions who have book debts with them and they are in the need of finance in the shortest period of time. Factoring implies a financial arrangement between the factor and client, in which the firm gets advances in return of receivables from the financial institutions. It is a financial technique in which there is an outright selling of trade debts by a firm to a third party, that is factor, at the discounted prices. Now suppose Mr. X is there, who is a seller, and Mr. A is a purchaser, and there is a deal between Mr. X and Mr. A on the credit basis. The amount is ₹5 lakh and the time period is 4 months. But right now Mr. X is in the need of money. So Mr. X contact any factoring institutions and sell his bills receivable receipt to this factoring institution, and factoring institution purchase these book debts and pay the amount after charging his service or after making a discount on it. So the total amount is worth ₹5 lakh, but Mr. X received suppose 4,80,000. So 20,000 will be known as factoring discount. And now when the maturity period overs, so after 2 months the factoring institution collect ₹5 lakh from Mr. A. So Mr. X enjoys immediate cash and factoring institutions enjoy additional of ₹20,000 by providing immediate cash to Mr. X. So this is how the factoring institutions are working. Factoring is a financial alternative in financing and management of account receivables. It states the terms and condition of the sale in factoring arrangement. In finer terms, factoring is a relationship between the factors and the client, in which the factor purchases the client's account receivable and pay up to 80% of the sum immediately at the time of entering into the agreement. The factor pays the balance sum, that is 20,000 of the amount, which includes financial cost and operating cost, to the client when the customer pays the obligations. So when the final amount pays by the customer, at that time factoring institutions will pay the remaining amounts to the client. But after deducting the financial cost and operating cost and service charges on it. So it is about the introduction of factoring institutions. Now let's see the advantages of factoring. The first one is immediate cash flow. Yes, when the seller is going to sell the book debts, there is an immediate cash flow from the factoring institutions. Then after, attention toward business operation and growth. When there is an immediate cash inflow from the factoring institutions, the client is able to grow his business operation with the benefit of immediate cash flow, and the client is able to grab the opportunity in the market. Then after, evasion of bad debts. Sometimes when the third party is act as a default, so at that time the client is not in a position of a heavy loss, because through the factoring process they gets 80% of the total debt in the security. The next one, speedy arrangement of finance. Yes, here client is going to contact any financial institutions who provide the services of factoring, and through these services they are in position to get immediate finance from this kind of institutions. Then after, no requirement of collateral. Here the client is not going to offer any kind of security at the time of selling the book debts to the factoring institutions. So there is no requirement of collateral when client is going to sell his book debts to the factoring institutions. And last one, that is, it is a form of sell. It is not a loan. Sell means client directly sell his obligations to other party, and in a return he enjoys a total amount of his obligation. So in a loan, sometimes it is possible that we are getting the borrowed money from the third party, and in a return we are paying additional interest on our borrowed capital. But this is the simplest form of sale. So when the sale is there, the client enjoys the benefit of total amount. So these are the main advantages of factoring services. Now let's see the functions of factoring. The first one is credit collection. Here, factoring institutions are going to purchase the book debts of his client, and the client received the immediate cash from the factoring institutions. So for that reason it is known as credit collection, where factor provides finance in return of purchase of book debts from his clients. Second one, maintenance and administration of sales ledger. Now on the behalf of client, the factoring institutions are going to maintain and administrate the sales ledger, because in the sales ledger they comes to know about what is the situation of credit sales and how this credit sales affect the liquidity position of his client. Third one, relieving client from the problem of trade debts. Yes, financial institutions are in a position to get relief to his client, because they are going to purchase the book debts, so the problem of trade debts will be minimized. Then after, credit control. With the analysis of sales ledgers by the factoring institutions, the factoring institutions are in a position to control the credit sales. If the organization is in the need of heavy cash, at that time the factoring institutions will not allow the client to sell the additional credit sales to the third person. So credit will be controlled by factoring institutions. Then after, advisory services. Now along with credit, factoring institutions provide services of expert advice in the marketing, in the technical aspects, and in the production aspects. So the clients gets the benefit of getting the expert advice from factoring institutions and other services. Last one. Now, along with protection against bad debts, they provide the services of advance cash, managing cash flow, and give the services of banking institutions. So these are the main functions of factoring. Now let's see the types of functioning. There are total 3 types of factoring. The first one is resource factoring. Here, in resource factoring, the client is not protected against the risk of bad debts by factor. So, if the client is not going to pay full amount at the time of maturity, so factoring institution are not going to protect his client against the risk of default. Then after second one, non-resource factoring. Here only a limited portion is going to be covered by the factoring institutions at the time of providing liquid to his client, and generally that percentage is 10%. So here factoring institutions take the 10% risk of the book debts when there is a default. But if there is a no default, then there is a no place for taking the risk of or making the risk coverage of his client in his book debts. Then after advance factoring. Advance factoring means in advance there is an immediate cash flow when the client is going to sell his book debts. So these are the 3 main types of factoring. There are total 10 types of factoring in your book, and just have a look on this type, but basically that is really very easy one. So here we are going to end our session. I hope that is clear to everyone. Thank you so much.